Welcome, everyone, and thank you for joining us for a short notice webinar. My name is Matt Petersen, and I'm NAGDA's Executive Director. Our annual conference is only a week away, so we hope to see many of you in San Diego soon. And usually we wouldn't hold a webinar this close to the event, but last week, the IRS Treasury released its final regulation for the catch-up contribution provisions of Secure 2.0. We know that's a big one. We've been anticipating these for quite some time. So we decided to set aside a little bit of time for this session to make sure that everyone understands what the regulations say, specific to us, specific to government plans, and to call out specifically places that we were actually acknowledged. So we're excited about that. To help us do that, I want to welcome David Levine from Groom Law. Welcome to the program. Good to see you again, David.
Good to see you, Matt. Thank you for having me. Hello, everybody. Thanks for joining us last minute, a week in advance of the conference.
Yes, the one last thing before the conference. So it's been a long road to get here. We know that it's been several years in the making. We've gone through different iterations of this. Some folks might not have been here that whole time, right? This process started 3 years ago. So can you give us a little bit of background, just some quick information for folks who may be new and not following this all the way through? And then let's talk about some details of the final regulation, obviously specific to public plans, and compare them a little bit to the proposed regulation. Like, what did we see that was different in this last bit?
Absolutely. And before I click over to the background slide, Matt, what I thought I would do is just sort of, we have the slides. They're designed to frame today. Matt and I are going to discuss as we go forward. But I think the real background in effect, and I might as well put the slide up, is that back in 2022, Congress passed Secure 2.0. And this isn't on the slide, but as way of backstory to your question, Matt, Congress basically had a requirement, and it's partially because of budgetary reasons and everything, that catch-up contributions for people who earn over $145,000 need to be Roth. Now, technically, these requirements were supposed to go into effect a couple of years ago. And what happened was people said, how do we do this? We need regulations. We need guidance. And at NAGDA, one of the things we've done is actually focused on how does this impact governmental plans? And as most of you know very well, governmental plans can't always turn on a dime. You can't change overnight. So at NAGDA, we had a number of meetings with folks from the IRS. We had multiple comment letters. And back in the first time around, we said, please delay this rule. And they gave us 2 more years. And they did. And we had a bunch of really productive meetings where we were out front and had good discussions with them. We gave them our arguments why. But then what happened after that is, well, to be realistic, people started working, but sometimes there were other priorities. Secure 2.0 has dozens and dozens and dozens of provisions. And if you're a sponsor, I'm sure you've seen this with your conversations with your record keeper. If you're a service provider like a record keeper, you know there's a lot to do here. So while people were working on this, you had to multitask. And I mean multitask to the nth degree. As a result, everybody was working on this, but it took time. And there's other players in this discussion because simply saying make catch-up contributions Roth for people who earn over $145,000 isn't as simple as that. There's payroll systems and what definition of compensation. And we're going to talk about that. So the IRS finally came out with final regulations. They come out with proposed regulations earlier this year. And a lot of folks, especially on the system side, were waiting to build things for final regulations. It's great it came out in September instead of November. But at the same time, we know that we're getting close to the deadline here. And as we were getting closer at NAGDA, we submitted comments to the IRS and asked them for a specific carve out for governmental plans for delay on the regulations applicable to governmental plans. And we got that. We'll talk about that in a little bit. And so that's a win for NAGDA. But the rule still kicks into place next year. That's the first starting point. So starting next year, that's when you, if you're a sponsor or record keepers and other service providers, will have to be dealing with Roth catch-ups. So the key is that when you get to it, underneath it all, this process is messy because you have a sponsor explaining to its employees, you have The payroll companies need to get their software and systems updated. Then, as a sponsor, you need to connect. Then you've got the record keepers figuring out what they can and cannot support. Because when you get regulations and you're waiting on them, you probably build one model. Each record keeper does a little bit different. We've had that discussions. So that dialogue with your record keeper is essential at this point. And then you have to test it and see if it all works. And that can be hard. So Matt, I kind of admittedly wove the first slide into the answer to the question, but hopefully that answered your question.
Yeah, and a few points on that. There was the initial law was passed and at 2024, and then we really worked, and David and I and the team from Groom and the legislative committee and the board, we all talked about, should we ask for a carve out for government plans to delay the implementation. But there was such an upswell from the entire retirement community to have this regulation delayed and get more time to implement, that we really felt like the best route was to go with everybody. Say, hey, let's all go in as an industry and tell them that we need more time. As the final regulation came about, and as we were in that time between the proposed regulation and the final regulation, we again had some conversations about, are our members ready? I heard from many of you, so I really appreciate hearing from many of you that there were still, blocks in the road that were going to prevent you from actually being able to implement by the end of this year. And so then that was when we went and said, it would be, let's ask for a carve. Let's ask for something specific to government plans. There's areas of the proposed regulation that addressed other groups. So I think we could get that through. And the IRS, and I will give a lot of credit to the IRS and Treasury in this case. They listened to us. The things that we asked for were specifically addressed, and David will talk about some of those in a minute. And I will eat a little crow because I was not convinced we would see anything from them before December 31st that said, hey, here's the final rule. So I know it, like you said, it's still kind of late, but it certainly gave us enough time to react. So I think we have to give them a lot of credit.
I wholeheartedly agree. And I think the next slide I sort of went into a little bit. Sorry, I deal with the questions, and obviously we don't want to read the slides to everybody who's been kind enough to join us today. We've already explained the $145,000 limit at this point. And this $145,000 limit applies to catch-up contributions. And we're going to talk briefly about the special 457 last 3-year catch-up. And we'll even touch on 403B for a minute. 403B has its own special catch-up rules. This is different than that. This is really about your age 50 catch-up contributions, as well as effectively your super catch-ups, the age 60 to 63 catch-ups. That's all woven into this discussion. And the key thing to keep in mind, and for many of you who know this already, thank you for staying with us for the basics here. It is $145,000 not calculated on your definition of plan compensation, not calculated on how you might apply the max. If you were a 403B plan, the 415 limits of 457 doesn't have that. In English, it's a very specific definition. It's FICA wages. And even there were some questions. What that means is, what are you tracking as a governmental plan on your systems? Because you might not have ever tracked FICA wages as part of your retirement plan. It might have been an afterthought or something you never thought of. And getting an extra payroll code, a slot to your payroll vendor with your record keeper, that's why this is challenging in just one way. And there were questions, and we'll deal with that in a minute. Matt, I don't know if you want to add anything here. If not, I'm happy to jump to the next slide.
No, that's great. All I will add is that if you have a question, please throw it in the Q&A. And as many of those as we can. We have a bunch that people entered from registration. So we already have a lot of questions, which is great. But if you have any more, throw them in the Q&A and we'll get to as many as we can.
Great. So we talked about the $145,000 limit. The final regulations, this is an area where there was confusion. The question was it box 5 of Form W-2, which is more Medicare wages, or was it box 3, Social Security wages? And differing minds could vary. And underneath it all, it is box 3 of Form W-2, Social Security wages that are used for the $145,000. And you might be saying, but we've already set up our systems and built everything. The IRS, and I second what Matt said, the IRS did listen. First, with the initial extension, they've been very collaborative. And even though I said we wish we could have things sooner, this has actually been a really good process because the IRS has really been engaged. They've been great at listening to comments. If you look at their final regulations, they actually, and this is part of their process, go through all the comments, but they accepted so many of the comments and concerns and addressed them in the final regulations. And for governmental plans, this was a big one. And they said you can use a reasonable good faith interpretation for now before the final regulations become effective. And here, jumping ahead to the answer, they're not effective for governmental plans next year. And you, depending on your legislative sessions and everything, you might actually, uh, you might actually have even more time as part of the relief that we requested from NAGDA and got. So don't worry, the sky isn't falling. Right now, do your best. And that's going to be our theme for today. And your record keeper may change and evolve. They're going to do their best, but that's okay under the IRS rules. So if you're set up for Medicare wages, that's fine. Now, the IRS had also said when we were engaging with them, they'd put out interim guidance about what they expected to be in the regulations before the regulations even came out. And in that guidance, they had said, look, you may not have FICA wages at all if you're not subject to FICA. And the IRS said, yeah, that can work. So if you are someone who is not subject to FICA, like Section 218 agreements and those types of things, for those who would like the wonky speak, we can go in the weeds. I don't think anybody really wants it, but just in case. Um, what happened is that state and local employees who are not covered by Social Security, you don't have FICA wages, you're not required to be Roth catch-up contributions. This rule just doesn't apply. Now, it doesn't mean you can't offer it. Of course you can. You've been able to offer Roth catch-up contributions forever. And maybe you want to do it. And also, if you are also part in an employer or in a plan where you can have some people in FICA and some people not, maybe you want a simplicity item. And this is something to work through with your record keeper and internally as you go forward, something we see discussions on. The key is this is something they had promised and the IRS delivered, so give them great credit on that.
Yeah, I think that's a great point. There is clarity here. So hopefully everybody who is in a non-FICA plan, and I know I've heard from quite a few of you, this should answer the questions that I've gotten, at least from many of you. So hopefully that makes that very clear. Still difficult, right? If you have some bargaining units who aren't participating in Social Security, you're going to have different treatments for different folks under your plan. You're going to have to work through how you want to implement that. And like David said, there are a lot of options. Your record keeper might have some opinions, so talk with them. But we know that it's box 3 that we're working off of here, which brings the clarity that we needed on the board.
Exactly. But the sky is not falling. That's our theme. If you ever read the books Hitchhiker's Guide to the Galaxy, the phrase I meant to use in the beginning was don't panic, because the IRS has been very good to us and we appreciate that.
Yeah.
Okay, moving on. I think I muted myself for a second, so I'm worried I can still be heard. All right, I'm there. So the impact on governmental 457 plans. Why are we really focusing here? Obviously, it's NAGDA, number one. Number two, there was language in the proposed guidance, but there were a lot of questions about how do catch-ups work. And I already stole the thunder from this one. The simple answer here is the governmental 457 special catch-up the last 3 years and the H50, you could be eligible for both. And the IRS gave us a clear answer in the regulations. And there's the regulations, and if you really want to be wonky, you can read the preamble, which oftentimes has things in English, which is a very good reading as well. Us lawyers, we read it, but it oftentimes does a nice explanation. And for those of you who don't want to be lawyers, it is also great bedtime reading if you would like to fall asleep. But it is very helpful. And it's great when the IRS gives it. So the Roth requirement, they basically explain that if someone is a high earning person who could do age 50 catch-ups and do the special 457 last 3 year catch-up, the portion that's basically above the age 50 catch-up has to be Roth if the person is subject to the mandatory Roth. Relatively clear? straightforward, and it's great. It's great that the IRS was actually able to do this, because I remember with a number of members of our legislative committee and other folks, we would have these discussions saying we think it's this, but we're not definitively sure. And it was good of the IRS to be precise and clear on this.
Yeah, and the proposed regulation, the language was hard to wade through at best, I would say. I know it made a lot of people nervous when they read it because it mentioned special catch-up, and we had been saying from the beginning, this doesn't apply to special catch-up, this doesn't apply to special catch-up. It doesn't apply to special catch-up, but it was an important caveat that they pointed out that there are circumstances where, you may have to apply it to the 50 catch-up at a time when somebody has used part of the special catch-up. So
Mhm.
a very narrow possibility that something like this, for somebody that's over $145,000 the previous year is
Mhm.
doing this exact thing. But they did address it, we cleared it up. So hopefully that's everybody is on the same page now. It does not apply to the special catch-ups, but there are circumstances where it may be touching on.
All right, Matt, I didn't mean to rush you there. I was actually looking to see we had a question come in, so I'm going to answer it in a little bit if that works. So, how do you calculate it? Basically, we've already said it's the amount exceeding the age 50 contribution. Also, the final regulations, there's lots of questions about how you do the catch up. Does someone need to have, does it need to be where someone makes an affirmative election? Can you default them into it? And for 401k and 403b plans, the IRS allows a deemed Roth election, basically saying you're deemed, if you're subject to this, to have elected Roth because you can't do pre-tax for the catch-up. Now, it was also requested for 47 plans, and they don't extend it at this time because they have governmental 457 regulations that are not done at this moment. But the reality is we've got the answer we need. That's the reality. The IRS has been moving over the past 20 plus years to make, where there's crossover on rules, consistency between 401k, 403b, and 457 where appropriate. And this is one of those areas where it's appropriate. So it's good to know you can do a deemed catch up. But remember, as I said at the beginning, don't panic. We have reasonable good faith. And that's also going to be relevant for those of you who don't have Roth catch ups and Roth at all in your plan. We'll come back to that in a couple of minutes.
Yeah, we can come back to that question if you want to keep it.
Yep, I think I'll tie it in a little bit here because it gets into the correction type of discussion here. Now, basically, you can do the automatic Roth treatment. Government 457 plans. Basically, you can kick into the Roth right after you hit the regular 457b catch up. So this is consistent with what we were talking about. Let me talk a little bit here because we do have a question in our chat that came up. There's a question the question we've received is, as a sponsor of a governmental 457b, which does not currently offer a Roth option, how does the 2027 applicability date apply to us? That's a great question. Put really simply, the regulations apply in 2027 or later potentially. And you have a reasonable and good faith standard before then as a governmental plan, but the rules actually apply next year. So how do you do it? There, you could obviously say no catch-up contributions at all for those subject to the Roth. But the IRS also has other items out there at this point that that allow you to sort of clean up and to allow you to clean up. You can basically move money around inside the plan and report a contribution for the year as a Roth contribution. So if your record keeper isn't up and ready yet, you can sort of clean up on the W-2 and get everything reallocated and moved. You'll have to work with your record keeper on this to adjust things and move things over. That's number one. Another one is you can put it into the pre-tax, but you can just do an in-plan Roth rollover. So you don't need to work with the W-2, and this is different, and convert it over and you issue a 1099. Many of you probably have in-plan Roth conversions to the extent you have Roth in your plan already. It's a common feature for a large number of plans at this point. These are two ways that if you can't implement, you have issues, you can look to possibly still allow catch-ups, but correct, depending on the timing of when your Roth will go live. So those are two examples right now. Matt, I don't know if there's anything you want to add here.
No, and I know there were a lot of questions about corrections. Obviously, this is down the road from down the road, it's after implementation and making sure that everything went right. But I did feel like this was clearer than anything they put out before on how do I do this process. And so obviously this is something that needs some coordination with your record keeper, needs some coordination with your team, but the blueprint is there. So like David said, not a rush, should have some time to implement, but the answers are in this final regulation and they do seem to.
Now, the key is, and I see in questions, we have one question. So the Roth provision, just for the person who joined us late, just wanted to answer very quickly. It applies to the age 50 and catch-ups, not the special 403B or 457 and 457 last 3-year catch-up. It does, but it only applies to the age 50 catch-up contribution amounts. It's addressed in the slides, which we will be sharing afterwards, and it does apply to the super contribution. So hopefully that helps. Sorry, we're trying to read our questions as we go to make sure we give answers to everybody as we move along.
That's good. We did get one, just to clarify something. Can you go back, David, a little bit on, and not
Sure.
on the slide, but just in something you said. So you mentioned that the rules apply in 2026, but the regulations apply in 2027. Can you explain?
Yes. Sure, and I actually think it's actually here. So the basic concept of this is that the IRS already gave us a 2-year delay, and admittedly they stretched. There's some history that they relied on to stretch the rule and push us out a 2-year delay on the Roth requirement for catch-ups. But that relief ends after this year. So starting next year, you as a governmental plan are required to do, for people over the 145,000 in FICA wages, to do Roth catch-up contributions. You can't do pre-tax. We already just talked about the correction methods. However, you have a reasonable and good faith standard before then, which also includes the correction methods on this slide that I just went back to that might be able to help you sort out where you're going. The key is that the actual regulations and some of the precise things, like we mentioned before, which version of wages, box 5 versus box 3, and also just trying to make things work. You have a reasonable and good faith standard. So do your best is right now. And for governmental plans, this is the provision we got at NAGDA. You get the later of, for taxable years beginning after the end of next year, in other words, 2027, or the first, and this is the standard sort of IRS and congressional speak on this, the end of the first legislative session of the governing body with the authority to amend the plan that begins after December 31, 2025. For some of you, that may still mean 2027. But for others who have multi-year legislative sessions, it may be you have even more time. So in essence, you have final regulations, but if you can't comply with them exactly and just do good faith, you're okay next year, no matter what. But you still are supposed to do this, and there's the methods to try to comply or come back into compliance if it applies to you.
And it is confusing and it's unfortunate. And I think and you can tell me if this is right or wrong, David, but the IRS has its limits, right? It can't say the law is now 2027 because the law is the law. But the IRS can talk about what it is going to expect from you and when it's going to enforce things and when it's going to start to look into stuff. So what they're saying, in essence, is as long as you're working, and I think, Greg Long put something in the chat, I think it's right. As long as you're working in good faith compliance towards being able to implement this, the IRS isn't going to come knocking at your door and say, hey, why haven't you implemented this?
I agree, and I agree with the way that Greg characterizes as well. People are trying to just be practical in this approach, and I know that's hard, but I think that makes sense.
We had one more question. I think this is an important one. So we've talked a lot about kind of the difficulties that multi-employer plan, which would be state plans that allow other political subdivisions, so counties, cities, anybody else to participate in their plan. Obviously, a little more difficult circumstance, usually working with multiple payroll providers across a state. But the the length of time that you have, that the IRS is saying that in 2027, they're going to, you have till the end of the year of 2026. That's not specific to multi-employer plans. There's no separation in any of the guidance, any of the rules, the final rule, anything like that, that calls out multi-employer plans specifically that I saw, correct? This is just governmental plans or governmental.
Well, we're focusing on governmental. I believe there is a pass. There was some language, and I admit I did not focus on it as much because I knew I was talking about this today, so I don't want to misstate. But I believe there may be there is a multi-employer plan, but multi is more bargained rather than multiple employer, and we get into that type of discussion. So like union bargaining could have another impact, which gives you time. But again, that's about compliance with the regulations, not the actual
Yeah,
like statutory.
all government plans in the same boat, right?
Exactly.
Go ahead.
I, and I think that takes us to the end, believe it or not. We tried to be efficient. We're happy to do questions. I know you may have some, Matt. We're happy to go into those.
Yeah, so we got one from Patty, and this is one we got in the pre questions as well related to payroll providers. So one of the things that has been probably most difficult about this in general is that you're talking about the plan sponsor having to coordinate with the record keeper, having to coordinate with the payroll provider. And not everybody is always on the same page, right? And I think there is there's some possibility that some of the tasks, some of the entities are going to point to the other entity and say, no, that's not our problem, that's theirs, right? And so the question, what if our payroll provider doesn't provide us with the necessary programming for Roth catch-up in time to meet any of the implementation dates? You want to speak to that a little bit?
Sure, and I think there's many paths. The IRS has given us a path for getting money moved over with some of their self-correction type of guidance, whether you do the W-2 method, where you basically move the accounts and report on W-2, or you do the in-plan Roth contribution at this point. That can be another path to do it. So that you can always, I can't say always, but in this case, the IRS has given us ways to basically self-correct if you just couldn't do it and have to clean it up later. And I think that's kind of the key way to deal with it. And it's important, though, to talk to your vendors, whether it's payroll and your record keeper, and say, how do you support this? Will you be able to help us do this if we do the correction? Because there's so much going on here. Not every vendor can do everything that's made available. So it's good to ask the vendors you work with, what are they supporting? Because that's the practical real world at this point.
And as part of this, when we send out the recording, so we are going to send out the recording for this tomorrow. We're going to send it out to the whole membership just so everybody's on the same page, whether you're registered or not. We are also going to include a link. So Spark, which is the Society for Professional Asset Managers and Record Keepers, kind of a sister organization of ours who represents the record keeping side. They have created some best practices for the record keepers, but it also has some information like questions plan sponsors should ask both their record keeper and their payroll providers. So Spark has lined out in their view. Now it's the record keeper's view, so you may want to, continue to ask questions, talk to your payroll providers and see how they view it. But, they'll say like, this is something that is the responsibility of the payroll provider. This is something that's the responsibility of the record keeper, and so on and so forth. So we'll send that document out to you as well, because I think it's important to see what the record keepers are working on and how they're thinking about this as they're working together. Like David said, there are a lot of fingers in the pie here, and so having everybody on the same page is going to be really, really important. All right, so now we can continue working through some questions. David, have you read any that you want to get to, or else I'll get into it?
If you would read them, that would be great.
So I think that this one is confusing, and I think it's really important, like how the interaction between the 50 catch-up and the special catch-up would work in practice. So can you give an example of that? And that's kind of what I think Sean was generally asking for, is where we would apply that both of those things would happen, and you'd have to think about, the 50 catch-up being Roth and not the special catch-up at the same time.
So sure, let's say your special catch-up limit is $3,000. You could allow $3,000 and the individual is 55. You could, and then they make catch-up contributions of $6,000. You could say 3,000 or 6,500. You could say 3,000 is the age 50 special catch-up contribution pre-tax. But then the, I'll say age 50 portion, which is everything above this, the 457B of 3,500 in my example, that would have to be Roth. It's as simple as that.
Okay. So if that didn't answer the question, send us a note. That's fine. So let's see. We got one from Anthony. Due to law, can the plan automatically perform an in-plan Roth rollover for any incorrect pre-tax catch-up contributions for participants without them initiating? I think that was a pretty clear yes. Can do
I
that.
think the answer is yes. It's funny. Automatically, I'm thinking about notice and everything, but I generally think the answer is yes. Right now, as we still work this through, I'm like, I haven't had to actually formally answer that, but I think the answer is yes.
Okay, so I think we got one of the lawyers asked a question because there's a lot of references to IRS code. So I'm gonna kick this one to you for sure. So under the proposed regs, it seemed unclear as to a plan was required to consider Roth contributions made earlier in the year. So prior to the 401A 30, 402 G7 or 457B limit, needed to count towards the catch-up limit. Has that been clarified?
There was some clarification about how you can do this that increase the flexibility. It gets rather weedy, but yes, there is clarification, I believe, in the regulations on this that actually breaks this out. It's probably better to actually look at your exact scenario in the regulations, but I believe there is.
Mhm. And this is a good question from Daniel in Utah. So what notifications are required as part of those in-plan Roth rollovers? So if you kick somebody over to Roth because they're over the limit and they didn't know it and they didn't elect that, you have to tell them, or what do you have to say?
I don't remember if they said specifically you have to do that right now at this moment, but I would think it would make sense to do that because people are going to have a tax hit and they need to know this as you go forward.
And that would be something too, I would say, just from a best practice standpoint and from a working with your record keeper standpoint. Once that happens, you would want to have a trigger in there somewhere that says, hey, we need to let somebody know or let this person know that happened to their catch-up contribution.
Exactly.
All right. So let's see. This is a good question, and it's one that we get in kind of different forms. So there was a question about the $145,000, which is always a trivial question, like where did $145,000 come from? So our understanding of it was $145,000 was a somewhat arbitrary number that sounded high, but also met a lot of the tax needs for passing Secure 2.0. So by converting some amount of money to Roth, it was a positive score on the budget. So you know how on any bill there is a score. They will say things like this is going to add to the deficit X amount over the next 10 years. By converting some money to Roth, because it's always looked at in a 10-year window, those contributions are seen as coming in now, and it actually adds a positive score to a tax bill. So 145 was the number they came up with to add a certain amount of money to the tax bill on the surface. Will that go? So the question was, will it go up to 150? And the question that I've gotten, we got in the pre-registration, and one that I've gotten from many sources is, hey, 100, in some localities, $145,000 isn't high earners. If you're in the area or if you're in New York City and you're making $145,000, you're not necessarily one of the high earning people that this was meant to affect. The answer, as far as I know it, is the $145,000 is $145,000, and it will remain $145,000 until it is changed. There isn't a locality determination. It would be very difficult to implement. Think about all the hurdles the payroll providers and record keepers are working on. If you had to do that by jurisdiction, that would add that much more complexity to it. This isn't indexed to inflation or anything like that I've seen, David. Do you have any other thoughts on that one?
Yeah, I think that's it. And it can adjust over time as we go forward. So I don't mean to be mean, but Congress didn't really focus on who they really consider highly compensated or not. This is a budgetary game. And I see one that came in. Someone commented, "We government employees don't have anything in box 3 of W-2." Well, some do, and some don't. So it depends, like Social Security coverage and not. That would explain it.
So this is one that we got a couple on. How do we handle somebody whose income, maybe a new employee? We don't know how much money they made last year. But you want to talk a little bit about that?
Yeah, there's a great answer. Thanks for the softball. I appreciate it. Not your problem, and then you can just assume they're eligible to do pre-tax. Basically, it's about you look on an employer by employer basis. How that works in a multiple employer plan, which is many of your plans. Um, that's it. And I want to come back to the person who asked the question on box 3 of W-2. If there's no information in box 2, sorry, box 3 of the W-2, that means you're not subject to Roth because there's no income unless there's a problem with your payroll provider.
To be clear, you don't have to implement this provision. You kind of
Yep.
get a pass, which is you're the only group. So congrats. Let's see. Is there an obligation to use the correction method for 2026 if the system is not in place to handle, or just to demonstrate that a plan is working towards compliance in 2027? And I believe it's the latter, right? You wouldn't have to, if you don't have it in place yet and you're still working towards it in good faith, you don't have to implement a correction for anything that you don't have in place at the time. Right?
Well, you will need to get it cleaned up eventually in terms of how you do it, I think would be the answer, because it does apply next year in
So
terms of
what would that look like?
well, you could use any of the correction methods. There's a question of what does good faith mean? Does good faith, I think there's a real chance the IRS would say good faith is not just ignoring it at this point, but I think they would say you could use one of the correction methods and that might work to do it.
We did have some members, and this was a question that I got as before the regulation came out, as folks were kind of trying to work through this. One of the questions was, well, I've done all this stuff and I'm actually going to be able to roll it out next year. Did this just kind of put me in a position where like now I might as well sit on it and wait for a year? I think the answer to that is very obviously no. You're actually in a really good spot. You're ahead of the game.
Agreed.
Put it in and then work going forward. I don't think this is going anywhere. I get that question a lot too. Is this going anywhere? Are they just going to get rid of this provision?
No.
I don't think so.
This is not like the Cadillac tax was years ago on high value healthcare. Yeah, please.
A good question here from Michelle. Is it the employee's responsibility to monitor if they're a new hire?
No.
Yeah, no, it isn't. And so you kind of have like 1 year if you have a new employee or a new employee that you don't have to worry about their previous year wages. Is that correct?
Right. Yeah, you don't, if they're a new employee, they haven't been employed by the employer before, it's employer by employer, and that's the flexibility.
All right. What do we know about the Roth catch-up requirement getting extended for governmental clients? Any additional nuances? I think this is it, right? And I did want to
Yes.
where we are clear about that. This is the final reg. There isn't a next step. There isn't any more information that they're planning to send out or required to send out. Is there anything you expect to see in the next 6 months to a year that would address anything else here?
Right now, we are trying to keep the government open. So barring some like decision to show bipartisanship where they do a retirement bill, which is still relatively bipartisan, but it's less than it used to be, I'd be shocked if we had anything at this point.
So we got one from the registration questions that I just wanted to bring up, that they asked, what are other plans doing? Like, how are other plans putting this stuff in place? I think that's an important question. It's one that you should all be asking all of the time to each other. I want to point you, we have a directory we have a member directory on the website. If you're a member, you can go to the directory and you can search by either name or location or whatever you want and find somebody who you think can help answer your questions. Obviously, next week we have a conference. So at the conference, I'm sure this is going to be a topic. Ask your friends. But if you're not coming, or if you're, you have questions after the event, you can always reach out to other NAGDCA folks. And if you can't find somebody and you ever are in a position where you go, I don't know anybody who's in my same spot, there's somebody out there who's trying to do the same thing you are somewhere, especially with this.
Mhm.
Just write us. You can write me, you can write, the NAGDA inbox, just the generic one on the website. We'll get you an answer to whatever you're trying to figure out, and we'll put you in touch with somebody who's going through the same stuff. There's somebody there. So don't ever feel like, nobody else is working on the same thing or has, the same issues. There's somebody out there who has the same unique features yours does, and they're working through it, and collaborating on that stuff is going to make it all that much easier. So I just want to put a plug in for that. Okay, we've got a bunch more. So maybe we're not going to finish early, and that's good. So we'll hang out. So can you elaborate on Rhonda's question? For example, if someone can do the full 3-year catch-up, everything above the base able to be pre-tax, or is only the amount up to the 50 limit of a special catch-up pre-tax? So this is a complex one, so we try to walk through.
The simple rule is up to what you can do as a special catch-up is pre-tax. Everything above that, if you're subject to mandatory Roth, is Roth.
As long as you're okay. As long as you're in the situation where you're
right.
Okay. So a timing question: if a correction is done both retroactively after the W-2s were issued, would we need to perform both an in-plan Roth conversion on the participant's account and provide a corrected W-2? So would you have to provide a corrected W-2?
This one I will hedge, but I believe the answer is no. I think you do the W-2 as is, and then you do a 1099-R showing the in-plan Roth contribution. Now, where this gets weedy is what year should it be for, and all those different items that I can't answer off the top.
Yeah, that's a complicated one. So a good one to talk through with your
advisors
and advisors. What advice are you providing for government plan sponsors who want to adopt a Roth mandate amendment now, which is well before the plan amendment deadline?
It depends on what your plan document is. That's a great question. Because if you are a custom plan document, my general advice is wait until you absolutely have to do it, unless you have some political or other reason you have to get it done. Because we're still waiting, the 457 still might get a little bit more out there, but this is it. But we make it a little bit more, and you have deadlines. You can have up to like 2029 to amend your plan here, so you have some time. But that's number one. Number two, if you're on a pre-approved document, you have to talk to your different record keeper, because some record keepers really want their documents updated for system management and everything purposes. So you have to see to work with your record keeper vendor who prepares your amendment. And sometimes we review them and tweak them. Sometimes you go with them, but that's kind of the approach.
So this is a good one. And you did mention this, and I think it'll be good to clarify. So if a plan has, say, a 401k and a 457, and you mentioned that the deemed authorization was spelled out for the 401k and 403bs. The 457s was a little different. Can you explain whether or not there is a deemed authorization?
I will give my view that is not legal advice to everybody on this call, since I have to disclaim it. I think arguably you could do a deemed in a 457, because if they're laying it in a 401k and 403b, I'd expect it there, but we will have to see.
Yeah. So Vanessa asked about the implementation timeline again. So the way she framed it, are you saying that plans are required to implement in 26, but there's no consequences if they aren't done, and also no consequences if they don't do the corrections, as long as they show they're working towards implementing in 2027?
I'm not sure the IRS is going to agree that you can just leave it as pre-tax. We could debate that. That's a whole nother discussion. I think that it's not an extension. It is an extension on the regulation. But good faith, this gets into the debate of what the IRS would consider good faith. So simply doing nothing and saying we're working on it, I'm not sure that will get you there at this point. I think there's a real chance it won't.
But as long as you're working on the process to implement this provision, and you're going through all the hoops and you're setting up all the stuff,
and then clean it up afterwards.
And then cleaning it up afterwards. So you will have to keep an eye on who next year wasn't switched to Roth when they had needed to be, correct?
And how you clean it up and address it all.
Cleaned up after the fact. But
Yep.
there is grace to allow you to work through next year if you have implementation issues.
Yes, there is.
All right. Let's see. So interesting question for Greg. So if a plan's special 457 is in all situations higher than the 50 catch-up, does that make
Yes,
it move from that point?
yeah, arguably it does, because that doesn't have to be Roth.
Okay. You want to say?
I can't think of an example why it'd be a concern, but yes.
All right. So we have a deemed IRA, Roth IRA. So we'll talk about that. You think that it would be acceptable to do a rollover to the Roth IRA prior
No.
to designated Roth being, okay. It's pretty,
A deemed IRA is part of the plan, but it is not in their correction method. It's going into a Roth account in 401k. Maybe the IRS would be fine with it, but they have not addressed that.
so good question there, but a clear answer. All right. So a lot of 3-year catch-up questions still. Let's
Right. And I'm going to, if you don't mind, I'll grab a couple of these here. I think the short answer is, if you can do a 457 special catch-up and your catch-up contribution is inside the amount that you could go up to there, pre-tax. So yes, that means Roth may have no meaning for those people. So regardless, there's a bunch of examples, but they're all basically in the same vein. If you have a special catch-up limit that you can use that would cover the amount of the catch-up, that can be pre-tax. It's only if you have to use the age 50 or super catch-up at age 60. Otherwise, you're not required into Roth.
hopefully that's clear. I know we did get quick through this. So I like how this one's framed. What's the minimum we're on the hook for this year, given the good faith effort, if we haven't implemented the changes?
Well, make the good faith effort is my response. I don't have a ideal minimum I can give to that. Make the good faith effort, and you're probably gonna have to clean stuff up if you haven't cleaned it up, but you can clean it up after you finish your good faith effort, I think would be the argument.
Yeah. Okay. So we have a little bit more time. It looks like the questions have slowed down. I'm not seeing any. I may have missed some. All right, we got one more. So if you do not have the designated Roth in place and you allow pre-tax contributions, it sounds like pre-tax contributions subject to the catch-up rules could be restricted from withdrawals and rollover distributions. Is that correct?
I don't have an answer to that at this point. That's an implementation item at this point.
Let's see. I think we got everybody else's.
I think we've answered the questions. Yeah, I'm walking back through.
So I will say this again. This isn't we know this isn't the end. We wanted to put this together so that we could help you understand what this said and get off on the right foot. Plenty to talk about next week as we meet in person. Plenty to talk about, as we said. I'll send out the information from Spark. And the record keepers. There's a lot to talk about with the payroll folks. There's a lot to talk about the record keepers, who's responsible for what, and getting that all ironed out. We did get one from Vicky. We went through a lot of system upgrades in the bank, went through several mergers. We don't have a history of unused contributions. So if you don't have the information on the special 457, like the special catch up, and you don't know where they're at on that, I think that's what that question might be getting at. Does that make sense? Do you have any advice for that one? I won't call it advice, but
I don't have a good answer on that one at this point.
that's one where you'd have to talk to your advisor on that and try to
Yes.
figure out how to clean up that process and figure out what.
And I do think someone asked in there, did we answer the question about multi-employer? I think it's important for me to go back. We did. I think we did answer it, but it's a little messy. So I'm just going to try to pull that one back for a second here.
Okay.
We should define terms. If your plan covers multiple employers, that is not a multi-employer plan. That is a multiple employer plan. And the reason why I get into that is there's no special rules for multiple employer plans in this regulation. But if you have collectively bargained, I believe, and I'd have to go check, I just hadn't rethought about it. I'm pretty sure it's there, but I don't want to overstate that there is a rule for collective bargain plans and delayed effective date of the regulation. That doesn't change the effective date of the rule next year. But you have the reasonable good faith there, just like we do for governmental plans, like we've talked about. So I think it's that discussion. Hopefully that helps.
Okay, so this is a good one from Galen, and she pulling me back to it. What about people who've already put money in Roth during the year? So say you made, $10,000 in Roth contributions during the year. So she's saying apparently, and I don't know where you heard this, Galen, but apparently if they put the same amount in as the catch-up in a given year, they don't have to do catch-up in Roth, but could do the catch-up as pre-tax. Is that correct?
That's what we talked about. I talked about that in the preamble. The preamble gets into some real discussion on that, and it did give us some relief on that. It's worth taking a look more closely.
Okay, so the answer there is that's correct. That if
I'm caveating, I believe that is correct. I just have to go back and look at it to be precise on that, but yes. And I think we just got another question.
Yeah, if I made 160 this year and over the age of 50, contributed the max to age 50 as pre-tax as an employer, can we report that, or am I required to move the 50 catch-up amount to Roth on the W-2 for
this year? There's no Roth required contribution, so
that makes sense to you, hopefully. Okay. Like I said, we're going to continue this conversation. So if you go to our website, we have a lot of secure resources. We probably won't have all of the 603 information updated this week, since most of the staff is getting ready for San Diego. But as soon as the conference is done, we'll get everything up to date and make sure that it has all the links that we're talking about. We will have access to the slides. We'll send those out. We're going to send out the reporting to everybody, and we're going to send out the information from Spark as well on the implementation best practices. So hopefully this cleared up some of the information. I know it's still there's still a lot to walk through. There's a lot with special catch-up. There's a lot with the effective date and kind of how to think through it. Make sure that you're talking to your record keepers. Make sure you're talking to your advisors and everybody's on the same page. If you have a record keeper or somebody in your ecosystem of service providers who's saying something different, please let us know. Please let me know. Send me a note. I would love to talk to him, because we want to make sure that everybody's on the same page as we're implementing this. That's the most important thing, that we're all walking forward in the same to the same tune. I think we're most of the way there. These really did help. I know there's still some questions involved in this.
I know the mixing of the catch-ups between the age 50 and your special can drive people batty, and we totally get it. So I'm sorry if I keep saying the same thing over and over. I understand it's hard to work through.
And I think it'll make more sense as it gets implemented and people get the procedures in place. David, as always, really appreciate you taking the time to answer a lot of questions. And thank you, everybody. We hope we see you next week. Really appreciate you showing up. Take care.
Thank you all so much. Bye-bye.